Welcome to part 2 of Chapter 13's lecture series. On this second set, we're going to first explain and apply methods of horizontal analysis. Again, horizontal analysis refers to an examination of financial statement data across time. The term horizontal analysis arises from the left to right or right to left movement of our eyes as we review comparative financial statements across time. Comparative statements. When we compare financial statements over relatively short time periods, 2 or 3 years, it is done by analyzing changes in line items. A change analysis usually includes analyzing absolute dollar amount changes and percent changes. Both analyses are relevant because the dollar changes can yield large percent changes inconsistent with their importance. For instance, if a 50% change from the base figure of $100 is less important than the same percent change from the base amount of $100,000 in the same state. Reference to dollar amounts is necessary to retain a proper perspective and to assess the importance of changes. We compute the dollar change for financial statement item as follows. The analysis period is the point of period of time when the financial statements under analysis, and base period is the point or period of time for the financial statements used for comparison purposes. The prior year is commonly used as a base period. So when we're looking at the formula that they show, we take the analysis period amount, subtract the base amount. Base amount again is usually the prior year. That will give us the dollar change. So if we do it as a percentage, dollar change divided by the base amount times 100% to change it into a percentage. When calculating the change as a percentage, we divide again the amount of the dollar change by the base amount period and then multiply it by 100 to convert to a percentage. Here we're looking at a comparative balance sheet. The comparative balance sheet consists of amounts from 2 or more balance sheets arranged side by side. This method of analysis is improved by showing each item's dollar change and percent change to highlight large changes. So when we look at the cash and cash equivalents, this is year 15, this is year 14. 14 is our base. The change from 15 to 14 gives us the dollar change, and then of course we calculate the percent change. This is horizontal because we are looking across like the horizon. Analysis of comparative financial statements begins by focusing on large dollar or percent changes. We then identify the reasons for these changes and, if possible, determine whether they are favorable or unfavorable. We also follow up items with small changes when we expect the changes to be large. When looking at this exhibit 13-1, it shows the balance sheets again for Apple. A few items stand out on the asset side. Apple's cash and cash equivalents have changed by 52.6%. They've increased, and short-term marketable securities have increased by a whopping 82.3%. This is a substantial increase in liquid assets in response. And Apple raised its 2016 dividend 9.6% and increased its share repurchase plan by 25%. Dividends and share repurchasing plans are likely to slow its growth of cash and short-term securities. Other notable increases occur with other current assets, partially related to derivatives, 2, vendor non-trade receivables, and 3, long-term marketable securities. Interestingly, accounts receivable decreased by 3.5% while sales increased by a 27.9%. This suggests that Apple is improving its collection of receivables, which is a positive trend. On Apple's financing side, we see overall 25.3% increase is driven by a 42.3% increase in liability. Equity increased by only 7%. The largest increase is due to long-term debt, which increased by $24,476 million, or 84.4%. Much of this increase results from bond offerings by Apple to take advantage of low interest rates. We also see a modest increase of 5.9%, which equates to $5,132 in retained earnings, even though income is $53,934, which is mainly because it's cash dividends and stock repurchases. So we can see that this comparative balance sheet gives us a lot of information. Comparative income statements are prepared similarly to the comparative balance sheets. The amount of 2 or more periods are placed side by side with those additional columns showing dollar change and percent change. This slide shows Apple's comparative income statements. Apple reports substantial sales growth of 27.9% in 15. This finding helps us support the management's 25.3% growth of assets reflected in the comparative balance sheet. The 24.8% growth in the cost of sales in light of the larger 27.9% in sales increase suggests greater control over its cost. Additionally, the 24.2% increase in operating expenses is less than the 27.9% in sales growth, which again is good news. Much of the 24.2% increase in operating expenses is driven by greater research and development cost, from which management and investors hope to reap future income. Apple currently reports an increase of 31.5% in income, which is mainly driven by the 23,089 million growth in gross margin. Trend analysis, also called trend percent analysis or index number trend analysis, is a form of horizontal analysis that can reveal patterns in the data across successive periods. It involves computing trend percents for a series of financial numbers and is a variation on the use of the percent changes. The difference is that the trend analysis does not subtract the base amount in the numerator. To compute the trend percents, we do the following. Select the base period, assign each item in the base period a weight of 100%. Express financial numbers as a percent of their base period number. These are four of Apple's current and prior financial statements. The base period is 2011, and the trend percent is computed in each subsequent year by dividing that year's amount by its 2011 amount. For instance, the revenue trend percentage for 2015 is 215.9%, computed as 233,715 divided by 108,249. It's trend percents using the data from Exhibit 13.1, and they're shown in Exhibit 13.4 down here on the bottom. Graphical depictions, some people like pictures better than they like numbers, often aids analysis of trend percent. This slide shows the trend percents from the prior line in a line graph, which can help us identify trends and detect the changes in the direction or magnitude. It reveals that the trend line for revenue has been exceeded by both cost of sales and operating expenses in 14 and 15. In years prior to 13, the sales trend line exceeded both cost of sales and operating expenses. The market increase for cost of sales in 13 is concerning, with a reduction of the difference in trend lines for 14 and 15. Long-run profitability will suffer if those costs are not controlled. By 2015, the difference in trend lines is reduced, and the net sales is nearly on par with the cost of sales. So here we have a little need to know. It's just a little test on what we've shown in the previous slides and to figure out the math that we need for it. So to compute trend percents for the following accounts, using 20x1 as the base year, round percents to the to whole numbers. State whether the situation as revealed by the trends appears to be favorable or unfavorable for each account. So we take the sales for each year, divide it by the sales of our base year, and we'll start on this side. So here 100%, the year divided by our new base year, 200. Here we have the 250 divided by the 200, it gives us 125% of the base. And then in the third year, 350,000 divided by 200 gives us 175 increase from the base. And then lastly, in year 4, the 500 million in sales divided by the 200 gives us a 250% sales trend. The cost of goods sold, we do the same thing. We start with the year 20x1 as our base, divide it by itself with 100%. And now we have 100 divided by that 50 for 2, and 175 divided by 50 for 350%. Lastly, the 400 divided by the 50 for 800%. This shows a worrisome trend. While sales has increased by 250%, the cost of goods sold, what we're spending for the stuff that we're selling, has gone up by 800%, which is a very large concern, and management absolutely has to take a look at this.